Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're diving deep into the Q4 and full fiscal year 2025 earnings call for U.S. global investors. That's traded on NASDAQ as GOAU. Our mission, as always, is to cut through the noise, distill the most important insights, and deliver them directly to you, helping you understand what truly matters in this material.
Yeah, and this deep dive into GOAU comes after, well, a fiscal year that presented some significant challenges. And we saw the market react with a bit of cautious sentiment, didn't we? The stock saw a slight dip right after the announcement. So we'll be exploring the specific reasons behind that reaction and, maybe more importantly, what management's actually doing strategically to navigate this environment and, how they're positioning themselves for growth going forward.
Okay, let's start by laying out the headline numbers. Fiscal year ended June 30, 2025.
Yeah.
U.S. global investors reported a GAAP EPS of -3 cents.
Which is quite a notable shift from the positive 9 cents they hit in the prior fiscal year. So yeah, big difference.
And Q4 itself closed with a small net loss too. On the top line, operating revenue
came in at $8.5 million. That marks a substantial 23% year-over-year decrease.
Wow, 23%. That's significant.
It is. And that revenue decline, as you said, was primarily a direct result of a pretty big decrease in their average assets under management, or AUM. For fiscal 25, average AUM stood at $1.4 billion.
Down from $1.9 billion in 24.
Exactly. And by year end, it was sitting at $1.3 billion. So you can see the trend there, clear impact. But despite these, very real headwinds, the company managed to report a relatively contained full-year net loss, only $0.334 million. And that was largely thanks to a crucial offset from other income on their balance sheet, really cushioned the blow.
Interesting. It sounds like that other income was a critical piece of the puzzle this year. Now, shifting to capital returns, U.S. global investors stayed active here, right?
They did. They repurchased over 801,000 shares.
Which is about $2 million worth.
Yeah, roughly. And importantly, they kept up their consistent monthly dividend. That's $0.0075 per share.
And that's authorized through September 2025.
Correct. But what's maybe even more critical here is the underlying strength of their balance sheet. It still looks really robust.
Okay, tell me about that.
Well, they're boasting $24.6 million in cash and equivalents and a solid $37.2 million in net working capital.
Okay, so let's unpack this a bit more. The company did record an operating loss of $3.7 million for the year. But as we just touched on, this was largely offset by that $2.7 million in other income, leading to that relatively small net loss overall. The containment of that loss, despite those operating challenges, that's pretty remarkable. How exactly did they manage to pull that off?
That's a great question, and it really highlights something kind of unique about U.S. global investors, that other income, it mostly came from realized and unrealized gains and losses on their own investment holding. So what's really insightful here isn't just that this income offset the operating losses, but how they do it. Unlike a lot of pure play asset managers, U.S. global investors strategically uses its strong balance sheet almost like an active investment vehicle itself.
Right.
This isn't just idle cash. It's a critical internally managed asset pool that's designed to generate alpha. And that acts as a kind of fundamental hedge against that AUM volatility we talked about.
And helps fund the dividend.
Exactly. It directly underpins their consistent dividend policy. And interestingly, the current year actually saw lower realized and unrealized losses compared to the prior year.
Okay.
Which significantly helped cushion the impact of the operating challenges. And you see the strength reflected in their current ratio too, 20.9 to 1.
Wow, 20.9 to 1. That's huge.
It really is. It means they have over 20 times the current assets to cover short-term liabilities. A very robust position for weathering downturns.
That's a powerful differentiator, no doubt. Now that operating revenue decrease, the 23% drop, you said it was explicitly tied to the decline in AUM, and we know their JETS ETF felt a particularly strong impact. Management even used the word apathy to describe the sentiment for JETS and gold. That paints a pretty stark picture, doesn't it?
It really does. And it brings up an important point. How sensitive is GOAU's business model to these AUM swings?
Very, I assume.
Very, yeah. Revenue is directly linked to AUM. Management basically said, look, we can't control market sentiment, but what we can control is the quality and uniqueness of our products.
Makes sense.
So they see these AUM shifts mainly as signs of that market apathy, not necessarily a problem with their actual funds. And they're committed to weathering these cycles. It's also interesting, they mentioned the DNA of volatility for GOAU. The stock itself has actually decreased.
Oh.
Yeah, it's now less volatile than the Dow Jones U.S. Asset Managers Index, which is kind of intriguing when you think about it, because their underlying asset classes like airlines and gold, they can be pretty dynamic, pretty volatile.
So it speaks to maybe operational stability despite that exposure.
I think that's a fair way to put it. Yeah, stability in their structure.
Okay, so we've looked at the financial challenges, that impressive balance sheet. Let's pivot now to management's strategic playbook, because it sounds like this isn't just about riding out a storm. It seems more like a fundamental shift, right?
Right.
Repositioning GOAU from maybe a broader manager to a very specialized kind of boutique ETF provider.
Exactly. Focused on identifying and capitalizing on what they see as underappreciated structural megatrends.
So what was the core strategic narrative coming out of the call?
Well, they definitely acknowledged the challenging fiscal 25, pointed to things like tariff uncertainty, general sentiment pressures. But their forward-looking strategy, it leaned heavily into that specialized sector expertise and product expansion. They're really positioning themselves around niche ETFs, using what they call a quantamental strategy.
Quantamental. Okay, break that down.
It's basically a blend, right? Combining cutting-edge tech and data analysis with robust fundamental research, quantitative plus fundamental. And they also talk about smart beta 2.0. For listeners, that essentially means moving beyond traditional smart beta, trying to incorporate more dynamic, maybe active-like factor exposures within that ETF wrapper to capture specific market opportunities.
Okay.
And their focus seems to be clearly on three main themes: gold, AI and defense, and global reach through shipping.
Right, let's tackle gold first. It hit all-time highs in 2025. Yet paradoxically, we saw some big traditional gold equity ETFs like GDX actually bleed assets, significant redemptions.
Millions.
So how is GOAU product holding up in this kind of weird environment, and what's their angle on it?
Yeah, it's a fascinating situation. Management stated their GOAU ETF has actually held up remarkably well in terms of fund flows, especially compared to GDX. At GDX redemption, they think might be partly hedge funds unwinding shorts or just taking profits after the run-up. But the macro story they're telling is really compelling. They're pointing specifically to China and the BRICS nations pushing this D-dollarization idea, which, they argue, is leading central banks worldwide to seriously ramp up their gold holdings.
Right, we've seen reports on that.
Exactly. Combine that with what they see as, let's say, excessive money printing in G20 countries, and they believe this structurally drives sustained interest in alternatives like gold. And even Bitcoin, actually.
Right. They have some crypto exposure, too.
They do, through their Hive investment, and also redeploying some capital into the crypto ecosystem after the Genius Act approval.
Which simplifies digital asset investing for some entities.
Correct. So their quantamental approach for GOAU, focusing on things like revenue, cash flow, royalty models, it's designed to pick the strongest miners in this evolving gold landscape.
Okay, moving from gold, another big pillar of their strategy is AI and defense. That's embodied in their war ETF, launched back in December 2024. Management's calling this a super cycle. But, for investors, isn't there a risk here? This theme could get overhyped. Maybe it's vulnerable to sudden policy shifts or budget cuts.
That's a very fair point. A crucial question for any super cycle theme. GOAU's management seems to acknowledge the hype, but they root their thesis in what they see as fundamental structural changes. They highlighted that massive $2.7 trillion global defense spend in 2024, and they see continued growth. Events like the conflict in Ukraine, primarily, they argue it's creating a permanent higher need for AI-enabled defense systems, autonomous weapons, really robust cybersecurity. They pointed to long-term commitments from NATO members, Germany pledging to meet, maybe even exceed 2% GDP for defense, some talk of up to 5%.
Wow.
Poland, Greece making substantial multi-year increases. And this spending, they argue, funnels directly into the enabling tech.
Like data centers, chips.
Exactly. Data centers, advanced chips like NVIDIA, specialized software. The war ETF aims to capture companies really leading that tech transformation, moving beyond just the old school iron and steel defense contractors.
And their quantamental process is meant to pick the winners there, mitigate some risks.
That's the idea. Identify those with durable competitive advantages, trying to filter out some of the more speculative froth you mentioned.
And this focus, it's not just domestic, right? They're pushing these thematic products internationally. Beyond the U.S. market, what's the strategy behind listing these ETFs like aggressively in other countries? What are the challenges and opportunities they see in places like Mexico or Colombia?
That's spot on. The international push is definitely a key pillar. They've successfully listed their CA ETF, the shipping one, in Mexico, and GOAU, the gold one, in Colombia. They're aiming to significantly broaden their AUM capture beyond just the US.
And they mentioned Peru, too.
Yeah, noted specific interest for IZ down in Peru. The strategy here is kind of multifaceted, right? It diversifies their investor base, taps into regions where there might be higher demand for specific themes.
Like gold in emerging markets, maybe.
Exactly, gold as a hedge. And it mitigates concentration risk. Plus, the opportunity is often in less saturated markets for these specialized ETFs. They can establish an early footprint.
Makes sense. And the AZA ETF, the shipping one, what's the deeper story there beyond just ships carry stuff?
Right. Well, 80% of world cargo by ship is the headline stat, the arteries and veins of global trade. But GOAU's deeper thesis seems to be about how geopolitical shifts, capacity constraints, that whole focus on supply chain resilience, how that's creating a sort of higher baseline for shipping rates, moving beyond just simple cycles.
So even with tariff worries.
Exactly. Despite tariff concerns, total imports are actually forecast to be up nearly 4% higher in the first half of 2025. And cargo shipping rates, they're not just stable, they're actually higher than a year ago, which leads to strong dividends from these shipping companies.
Gotcha. So they're finding receptive audiences for these kinds of growth plus income themes in these new markets.
That seems to be the play, yes.
So putting it all together, this aggressive pivot, this focus on themes, what does it mean for shareholders? Especially regarding capital returns. Management seems pretty committed there, even in a tough year.
Oh, absolutely. Their strategy revolves around a very clear two-pillar approach to shareholder value. First, those consistent monthly dividends, which really demonstrates commitment even when times are leaner.
Shows confidence.
It does. And second, opportunistic share buybacks. They've even got an algorithm, apparently, to repurchase stock on, quote, flattened down days.
Interesting. Disciplined approach.
Seems like it. They emphasized a robust shareholder yield of 9%. That's calculated as dividends plus buybacks plus debt reduction, all divided by market cap. And they view this as highly attractive for investors, especially, they noted, with odds maybe favoring rate drops soon. It really speaks to their confidence in that strong balance sheet and their long-term strategy, even while they're navigating these short-term AUM pressures.
Okay, but let's connect this back to the market reaction, gaining a 2.0% dip right after earnings. And broader underperformance against the financials ETF, XLF, over the past year. How should investors interpret that? Is this just a temporary rough patch, or is there something more fundamental going on?
That really is the core question, isn't it? Management acknowledged the underperformance, for sure, but they framed it very much through that lens of short-term apathy versus long-term thematic opportunity. Their shift, from the old mutual fund model to this ETF-led Smart Beta 2.0 strategy with global distribution, they explicitly describe that as a multi-year journey, a multi-year arc.
So this could just be transition pains.
Arguably, yes, part of that transition. The key challenge, like we discussed, is rebuilding that AUM in their main niches. And those niches are just inherently sensitive to macro factors, rates, the dollar, travel demand, commodity prices. But it's not like they're just waiting passively. It's a strategic repositioning, hoping to latch onto that structural growth.
So for listeners trying to track this, what are the near-term checkpoints? What are the potential catalysts they're looking at for that crucial AUM rebuild?
They pointed to several things. Domestically, they're anticipating maybe some strength in airline equities kicking in towards Q4. Internationally, they're watching Fed rate decisions very closely. That impacts gold, the dollar, both key for GOAU.
And the new listings.
Crucially, yes. They're expecting increasing traction from those new international listings of WAR, CA, and GOAU to start contributing more significantly to AUM. And then just broadly, if the overall markets keep climbing, hitting record highs into September, that general risk appetite could spill over and support flows into thematic ETFs like theirs.
But it's still a microcap story.
Absolutely. Classic microcap situation where liquidity, AUM cyclicality, it makes outcomes very path dependent. So these catalysts are really vital to watch.
And this whole strategic shift by U.S. global investors towards specialized ETFs, it's not happening in isolation, is it? It fits into a much bigger market trend.
You absolutely nailed it. What's really kind of mind-blowing here is that the number of ETFs available, it's now actually surpassed the number of listed public companies globally.
Wow, I didn't realize that.
Yeah, it's a huge shift. Management specifically noted the explosive rise of thematic and active ETFs, which of course aligns perfectly with their strategy. It means there's fertile ground for them to capture growth as investors increasingly seek more targeted exposure, looking for specific themes, AI, defense, gold, rather than just plain vanilla index funds.
So GOW is kind of swimming with a powerful market current, even if their own AUM has faced some recent headwinds.
That's a good way to put it, yeah. The tide is generally in their favor directionally.
All right, let's pivot now to our This Is Not Financial Advice segment. This is where we invite you to consider some, let's say, outrageous but plausible trade ideas, presented as if pitching to an investment committee. Remember, this is purely for educational purposes, creative thought experiments, not actual advice.
Okay, let's have some fun. Idea 1. The apathy arbitrage long grow with dividend-funded calls. So the setup. Management explicitly calls out apathy for jets and gold. They state AUM can turn very rapidly. GOAU stock slipped 2% post-earnings. It's lagged the financials ETF.
Okay, the outrageous part is betting on a microcap with declining AUM recently.
Exactly, that's the contrarian bit. But here's the plausible twist. GOAU pays that consistent 3.66% monthly dividend yield. So the proposal is initiate a long position in GOAU stocks. Simultaneously, use the expected dividend income over, say, the next 6-12 months to purchase long-dated, slightly out-of-the-money call options on GOAU.
So leveraging the dividend to fund the options.
Precisely. It leverages the company's commitment to shareholder returns to fund potentially explosive upside if those themes gold, ETFs turn rapidly like they think they can, and it caps the capital at risk for the options part of the trade. It's basically a dividend-funded growth bet on a stock maybe overlooked due to that market apathy.
Interesting structure. Okay, what's idea 2?
Idea 2. The de-dollarization disconnect. Tactical pair trade. Long GOAU, short GDX. The rationale here? Management highlighted GOAU's resilience in fund flows, right? Even as gold hit highs and the big market cap weighted GDX saw $3 billion walk out the door.
Possibly hedge funds unwinding shorts, yeah.
Right. We believe this sort of conundrum phase for GDX, the disconnect, might be nearing its end. So the trade idea is go long U.S. global investors, GOAU ETF, remember, that's the one using their quantamental approach, focused on revenue, cash flow, royalties, and pair that with a short position in a broad market cap weighted gold equity ETF like a GDX.
So betting on GOAU's methodology and flow resilience versus the broader index.
Exactly. It capitalizes on GOAU's demonstrated ability to attract and retain flows, its specific investment process, and the potential for a, let's say, cleaner upside capture if those macro tailwinds for gold de-dollarization, central bank buying really persist without being potentially dragged down by the structural or maybe technical issues affecting the larger, more passive competitors like GDX.
Okay, 2 interesting, definitely thought-provoking ideas there.
Yep.
So, to wrap things up, U.S. global investors navigated a challenging fiscal year. They reported a net loss, yes, but crucially, maintained a strong balance sheet and showed a clear commitment to shareholders through dividends and buybacks.
Yeah, and their strategic focus is now firmly locked onto those niche ETFs, leveraging really powerful structural themes, gold's strength amid de-dollarization, that surging AI and defense spending supercycle, and expanding their global distribution footprint. The path back to consistent profit and significant AUM growth really hinges on a successful rebuild there, which, as management believes, could turn quite rapidly, driven by these thematic tailwinds and their distinctive quantamental investment approach.
So, as you reflect on this deep dive, here's a final provocative thought for you to consider. Given U.S. global investors' strong conviction that market apathy can shift quickly and their unique quantamental approach, how would you, as an investor, try to identify the absolute earliest signals of a sentiment reversal in a microcap asset manager like this, one that's so highly exposed to specific and, let's face it, sometimes volatile themes? What data points, what market behaviors would you watch most closely? Remember, this information is for educational purposes only and is definitely not financial advice. Thank you for tuning in to The Deep Dive.